Welcome to the ProVest Pulse. I'm Gabe, and a little different today. You're not Noel. Peyton Hoppes is joining with me on the ProVest Pulse this episode. Peyton, how are you doing?
Good. No, I'm not Noel. We'll just leave it at that. I'm not Noel.
A little bit of a different kind of twist we're doing on today. We're using this episode to, of course, get you guys up to date on what's going on with the markets. A lot of fun news that happened the last week. A lot of fun data. And then we're also going to talk a little bit about transition. We're going to introduce Peyton a little bit. So tons of fun stuff. Don't want to waste any of your time. So let's go over some of that information. Peyton, your time to shine, buddy. Let's get a quick little summary on who you are, why you chose finance, where you come from. Give the people a little bit of information about you.
Sure. Appreciate it. Yeah, I'm clean shaven on the picture, and then I'm growing a goatee for fun. So, you get to have a little different look here. But yeah, my name's Peyton Hoppes. I'm from Spartanburg originally. Grew up in Bowling Springs. We just did a podcast, a radio show, and so that'll come out. You'll get to hear a lot of my story. But went to Clemson. My wife and I met there, and we live now in Spartanburg. We got 3 kids, Whitley, Wilkes, and Walker. They are 6, 4, and 2. At least their birthdays are coming up the next 2 months, so we're rounding up here in the household. Yeah, I've been in the industry about 10 years. I started out on a Ameriprise side of life, so it's a little bit different structuring, and then migrated to the independent side and met with Noel and Gabe over the past 6 to 8 months, and we struck up a good conversation. And so I'm here to help bridge the gap for transition, work with Gabe, and all the things fun there. And, I like to hunt. I try and work out as much as possible, but I'm just most of the time trying to get through the night sleeping. So I with the kids, it's difficult. But hey, man, I work with a lot of business owners and medical professionals and enjoy it. And I've enjoyed this career, but also want to serve people the way that they need. So a lot of people, Gabe, have information at their fingertips. They don't know how to use it or what's conflicting. And so I enjoy getting aha moments for people to help them understand or see something in their finances. And then as well as take all the information, compress it down to what's useful, and cut up and always make it simple, give you a game plan and rock and roll. So that's what I enjoy doing. It's a little bit of my background, and glad to be here to talk a little bit more about the market and what I'm really passionate about. 100%.
It's always good to have somebody with a little bit of family experience, especially going into a marriage myself. It's good to pick people's brains. Yep. Noel has that decades of experience. You got a little bit of experience. So aside from finances, it's good to talk to you about that as well.
There you go.
But yeah, real quick update to the viewers. Many of you know that we're currently transitioning from Cambridge to Fiduciary Alliance, which means we're moving from a broker-dealer to a registered investment advisor model. Tons of fun stuff that gets to happen with the firm because of that. But quick little update. All in all, with everything that we have going on, we're about 85% done with that transition. So just a little update for y'all. We're going to get full rocking and rolling with a bunch of new features that ProVest is going to roll out. Tons of new stuff. So after this transition is 100% done, you're going to see a bunch of emails and a bunch of notifications from me about new stuff you get to do. But nothing's going to change inherently about who we are. We just get to add a couple new bells and whistles to the firm, and we're super excited about that. But wanted to give you guys a quick little update on where we are in that process, because I know if you talk to Jenny or Pamela on the phone, they might let you know that we're not able to access the information where we used to because of the transition. So just a quick little insight on what's going on there. But what this means for you is tons of new bells and whistles. We get to add a couple of new things to the firm, and very excited about this, and going to talk a little bit about that more in the future. In this episode, we're going to go through a couple of different things. We're going to go through the market real quick. Tons of new stuff that got to come through across our desk, and a bunch of news that you probably have seen on the TV, like the war starting up and then going back into talks in the last 48 hours. That's been super fun to keep track of. We've gone through a little bit about what's going on with the transition. So we covered that, covering a little bit about what's going on with Peyton. And we're going to talk a little bit about a new model that many of you have heard in conversation with me and Noel about, or talking to me and Noel about, but me and Peyton have been trying to fine tune it and work towards it being client ready. So we're going to talk a little bit about that for a second. But Peyton, you delve into markets a lot more deeper than I have. While I've been investing for a while, you've been professionally investing for much longer. So talk to me about a little bit about where the markets stand currently, what you see at the moment.
Yeah. So if anybody's looking at the markets, they're usually interested in tech or growth or the shiny object. So historically, what we experience in the market is earnings every quarter. People get excited or they get depressed based on those earnings, and they become bullish or bearish on a company in the short term. And that is typically the wrong wrong vision to have. So what we've had this year is, well, we've had a war kickoff. We've had inflation issues, starting to come up. Like, okay, what do we do if it increases? We've had a new Fed chair. Are they going to cut interest rates or hold them or raise them? And they've held them. And then we've had a lot of volatility because of war and oil and gold and all the AI stuff. You have a basket of fun going on in the market. So market's only up. When we say market, folks, let's be clear. There's several ways to measure it. Dow, NASDAQ, S&P. Just as a whole, okay, looking at it, the market averaged out between all the numbers is somewhere around 7 or 8%, closer to 8%. So when we look at S&P, that's a different basket of stocks than Dow. Some of them are overlapping, but most are not. NASDAQ, same thing. A lot of overlap there, and depending on how you measure it, the point is the market's positive. Now, here's the deal. I've got an account that I have had a recent conversation about. He said the market's up 9, 10, 12%, and I'm not up that much. I said, I know, but we're also not chasing it when it comes down 25%. If you go look at any of those AI stocks, they're getting ravaged by all the headlines of, oh, this is a lot of spending and not a lot of return. And so then therefore people are like, this isn't worth my investment. They're pulling it out. Or they bought a year ago and they made a bunch of money. They said, all right, that's enough for me for now. I think there's going to be an opportunity to get involved, but for now, what we're looking at is simply a pullback in all the investments that people have made over time. And now we're looking at it from a perspective of it's a little overblown. Okay. So we get treasury yield, inflation's ticking up, but overall the market is looking strong, right? Like there's no reason to be super concerned with fundamentals. And we'll get into that in just a second.
Yeah. And see a lot of earnings. It's earnings season right now, which just means for the viewers out there that a lot of companies are now reporting how they've done the last 3 months. And so you've seen a lot of fluctuation. If you've seen fluctuation, that's mostly that's what's happening behind the curtains. But obviously, like Peyton mentioned, keep an eye on the interest rates, what's going on with the Fed, what Kevin Warsh is going to do in the future. He's just starting his career at the Fed, so keeping an eye on what he says he's going to do and keeping an eye on what he is doing is something that we're keeping a close pulse on. What the earnings of companies are, obviously, as advisors, we're keeping an eye on what might be a good investment, because at the end of the day, it doesn't matter if, now that we're RIA, I can talk about this, it doesn't matter if SpaceX has a valuation of 100 times price to earnings. The price is what you pay, and at the end of the day, value is what you get. So if you're willing to pay a premium for that company to perform perfectly for the next 50 to 100 years, at the end of the day, what are they earning and what are they returning to shareholders? That's what we care about. So at the end of the day, our whole philosophy behind investment is we're staying disciplined, we're keeping emotions out of it, and we're being as logical as we possibly can with decisions. This is some great information, Peyton, because a lot of people will look at the election cycles, and from what you and I have talked about, there's a lot of interesting things that are coming up based on what previous election cycles have done in the past. So talk a little bit about this graph and what the viewers can get from it.
Yeah. So simply put, when we look at all of their years averaged out since 1931, the S&P 500, we are looking at a 9 or 10% return. Okay. Now there's certain periods of time where if you look in the past decade, it could be 13%. You look in the past 15 years, it could be 12%. You can fudge the numbers however you want. The reality is when we look at averages and then we look at what an election year, midterm election year specifically, looks like, we have a very different profile. So historically, okay, and here's the funny part, folks, this is kind of what people expect, and it plays out a lot about the same every time, which is crazy to me. You have an average and the charts may not look exactly the same, but we could see a pullback here that matches the same time point in which you're seeing on the chart below, okay? But in reality, we have a midterm election year that we're in. Typically, the market's finished 6.5% up. So two things can be true. One is we can finish above market, meaning that we're at 9 or 10 or 8% or whatever we are, so we're above market. Or that's where we're at today as of August, and we could finish 6.5% down and we could still have a great year. So both can be true. We don't have to stick with one average. We can go above it, we can go below it. But the point is, we expect volatility in the midterm election year. People are making adjustments to obviously their political standings, their voting, and the market likes certainty. So when we have a lot of uncertainty who's going to be a senator or who's going to be in the House or who's going to be in XYZ seat, we can't make investment decisions mentally because we don't understand. Well, I don't know. Are they going to be bullish on gas cars or gas stoves? Are they going to be bullish on electric vehicles? Are they going to be bullish on tech stocks or business? And so all of these things shift how investors, in by and large, look at the market. And so that's where you get volatility. And so until there is certainty, until we get closer to the primaries and we see, okay, we know that Bob and Sarah are two options, I kind of get where we're headed, then we can't make a decision, okay, until we get to that point. Once we get to that point, people typically start to take off, at least in their assumption. So looking beyond that, we have a low typically through the summer. It's pretty volatile time in the midterm election year. And then once we get into August and into September, really sometime between middle of August and middle of September, we see a bottom. Historically, we see an average bottom, right? So it's relative to whatever the market's done this year. The market could pull back 2 or 3%, and that's the bottom for this time period. We're entering into it. Now, right there, kind of really where it says average midterm election year on the chart, that's where we could see, okay, maybe we headed to this pop. As of today, the markets are crushing it. Are we on the bottom side of that, sliding up and then it drops? I don't know, but here's the reality. Whether you are in retirement or you are accumulating all your net worth right now, putting that money to work, you don't need to panic, because that's really just a single day, single headline you read that makes you feel a certain way. And when we look at this chart, if you stay invested and we look out beyond October, we see on average there is a large return back to where we hope it all goes, which is up and to the right, bullish. So that's how we look at this chart. Here's the average. I'm not guaranteed. I don't know exactly where we're at on the chart, but even if we're above this in return, it still mimics this a little bit. And so we want to make sure that we stay disciplined in investments, and how and what we choose is just as equally as important as staying invested. So that's what you're looking at as far as midterm election year averages. And that's how we want to think about it going forward. It's not a time to panic. It's a time to be certain of where we're at.
Yeah, it's a good idea to keep an eye on what previous election years have done in the past. And this data does accumulate, or has started to accumulate, since 1931. So we are taking into account well over close to 80 years of data here in order to kind of get an idea of what's going on or what might happen based on previous years. Because obviously we can't predict the future, but we can make inferences of the past. But this is a great graph to talk about. Mag 7 has been a super big talking point, and I know a lot of people have called it the lag 7 due to their underperformance. Peyton, talk to me a little bit about what this graph means for investors, because free cash flow might be a little bit of an alien term for many people, but
sure.
Talk to them a little bit about what it means, and specifically what that red line means at the very right side of the graph.
So this is one of those, a little bit of AI talking points and a little bit of a great example of discipline. So this is the first time that Google has ever had negative free cash flow. This chart doesn't go all the way back until the very beginning of the company, but it goes back far enough for us to see since reporting they don't have a negative cash flow quarter or year. What that means is free cash flow is basically what I would call your either surplus or deficit in your personal spending. So every month I have $1,000 in surplus. That would be what we would say is your free cash flow. Let's just call it that. It's money we have left over each month for this company. There's some taxes involved, interest, depreciation. We're not going to get into all that. But the point is, their free cash flow is what they can use to fund investments, fund capital expenditures in their company to grow, to redo a building, to redo servers, to redo, or R&D, put money into research and development for the new XYZ, whatever it would be. So when we see it go negative, what that means is they have spent all their free cash flow for the year or for the projected coming year, and they have then borrowed money to put to work or issued money in new shares in order to get cash in the door to spend it. So they basically have overspent by several $1 billion of what they could have spent this year. So that's like you bringing in $1,000 extra a month. You don't need to do anything with it. It's there for me to save or invest or spend how I want. And you turn around and spend $5,000 over and above that. So you really spent $6,000. So that's essentially what we're looking at. Alphabet's done that. Google is banking on AI. And so you're seeing a big piece of everything tech and everything AI have a very similar playbook where they've overspent or they're spending a tremendous amount. And that makes people very nervous, because what if that does not return a good, or what if that does not give them a good return for their investment? This company is worth $1 trillion and they just spent $100 billion on AI advancement and expansion. What if that doesn't materialize to anything substantial in growth or returns or dividends? So these are the things people think when they see this, and that's what Alphabet has done. Google has put themselves in a position of super spending to get themselves, obviously they hope ahead. And I would be banking on Google to be right. Okay, Gabe, I would. However, as an investor, not real bullish in the short term to buy into them. Do we see this for the next 6 months, every quarter, every 3 months, for a couple of quarters, they report that this has not gone the way they hoped or it's taking longer for returns? I'm not a buyer, right? Until I hear some good news or I start seeing some good headlines and the company fundamentals support those headlines, then we're interested. And we're going to talk about a little bit of this when we get into some more granular details of investments. But this is just a good example of what's going on. And you can pick any other company out there, Mag7 especially, all except Amazon. They're doing great this year. Everybody else is taking it to the chin because of this exact reasoning.
Right. Because at the end of the day, if you're putting all the money that you have available into your, like you said, let's call it data centers, let's call it your AI model, in this case, Gemini for Google. If you're not producing a return, the free cash flow is what people look at because that's the opportunity for dividends, perhaps even areas of investment to actually produce a return. We don't know what's going to happen fully with AI. We know it's a transformative technology, but at the end of the day, when the internet came on board in the early 2000s, that was a transformative technology. When tractors came on board, history shows tons of examples of new technology that reshapes the investment world. But there's also comes some disruption, as many people might know from the dot-com bubble, which is a lot of talking points with this, but super interesting and something that we keep an eye on pretty consistently of. So deep value is something that we've been working at ProVest for quite a while, and Peyton has been a really big help to help make sure that everything is solidified and concrete with the investment philosophy behind deep value. But Peyton, talk a little bit about the deep value model itself, and then we can talk about a couple of examples about what might be inside the deep value model.
So deep value is derived from the idea that you invest in companies with a high value, but falling out of favor of their intrinsic value, as we call it. So ultimately, it's a concentrated portfolio of 8 to 12 stocks. We want to focus on company fundamentals. So I focus on increasing revenues or a catalyst to turn around and increase revenue and growth, or expanding margin. They spend less and they make more, right? Or they spend less on producing the same number or the same revenue and they therefore make more. And then we also look for some kind of what we call moat or catalyst. I mentioned it earlier. It's something that is giving them their competitive advantage or that they're going to do to give them a growth story behind it. With that being said, we also want to see good leadership in the company, and we don't want to see the owners of the company, CEO, C-suite, dilute the shareholders. So we want to see that they basically are growing a good company and that they will eventually repay us, the shareholders, in value. And so that's kind of where it derives from. So we're going to look at a couple of examples, and ultimately where you would see a large change in their price downwards, which you'll see in a second. That takes out some risk, and it takes out a lot of the hesitation on our end. Honestly, most people run from stocks that have fallen 50%, but we want to find a reason to buy them, and we don't want to be confirmed with our own ideas. I need this to tell me I'm going to buy it, right? I'm not already assuming I want to buy this company. I need to find all these good nuggets that are going to confirm what I'm thinking. I need for it to basically write itself off, and then I don't touch it. Or if we try and write it off and we can't, then it falls on the list of things that we're going to dig deeper on. And there's some more due diligence we do in underwriting, then we would enter into that position. So that's the idea. A lot of people see it as risky. It is in the sense that it's concentrated. So 8 to 12 positions, and let's say you had $300,000 that you put to work or that out of $1 million. That's risky in the sense that you're concentrated. But we de-risk the trade because we're ultimately underwriting the company to appreciate greatly in the 3 to 5 year window. And that all that fall that they have had off the top of wherever their stock price has been is the risk that we're all avoiding, or at least a large chunk of it. And so then from there, we go on and try and underwrite it where we have a pretty short time horizon, and we want to make sure that it does exceptionally well for us. So we want to be scrutinous in how we approach it.
Right. With that being said, let's talk about one of the examples that might be in the deep value model. Now, Wendy's. I don't think I've eaten at Wendy's in probably over 5 years. So Peyton, tell me a little bit about why this would be in deep value.
Well, okay. So I'm using Wendy's as an example of one we would evaluate. And I can tell you some reasons why. So it's not that Wendy's is the biggest and baddest and brightest. Wendy's is a good company. Now, let me tell you what we're looking at. So Wendy's was at, and this is a 10-year chart, $24 at its height, currently at $7.53. So a couple things you need to think about. When I'm trying to buy a company that I think is worth $20 or $15, I have to have a catalyst to get me there. And I have to have a leader that can see that and return that to the shareholders. Wendy's is currently paying at this price point around a 7% dividend. So if you put, just making up a number here, follow me, $100,000 in Wendy's, and it stayed at that price for forever, you would receive 7.61% in a dividend every year at that current rate. Okay. That's not how it works because the price changes. But the point is, that is a really good dividend, and they may cut it. They may cut some of the dividend to help improve cash flow and then go from there. But the point is, I'm still buying in. And if they grow the dividend later on, I'm buying in at 7%, and the stock goes from 7 to 12, 12 to 14. I've doubled my money, and my dividends still just continue to pay me at my $7 purchase. Okay. So for one, that's a pretty sweetener on top of everything I'm about to tell you. So that's an attractant. Okay. All right. I'm kind of listening. But beyond that, they have a guy named Bob Wright who worked at Potbelly Corporation, where he turned it around, and then they sold it off to private equity. So it never really got into the public market. But he has been involved with major chains like Domino's, Checkers Drive-In, Charlie's, Philly Southern, Philly Steaks. So he's had a lot of restaurant business, and he has come back to Wendy's. He's been a part of Wendy's in the past, and he has done very well. I mean, just overall, he's been shown to be a good operator. Okay, great. We got a good operator. So I'm on board with good operator. They have a program that they are going to do called Project Fresh, and that is a turnaround play. So there we go. We're looking for turnarounds in which they stop really what they did back in 21, 22. They started talking about dynamic pricings, where the price would change kind of like airports do. When you go and look up the ticket a bunch, they change the prices of your airfare based on how many people are demanding it or looking at it. And the same concept would happen for Wendy's, that their price could be higher during dinner or lunchtime that would be at 2 o'clock or say 10 a.m. And that was a big no-no. The industry as a whole doesn't do that, and nobody liked that concept. And so it took a big hit. Then comes Bob as of this year. There's a Project Fresh. They do have somewhat good cash flow and good production. Wendy's falls on our radar. It doesn't necessarily fall hard into deep value, but it has a lot of deep value-esque things. So we have put some clients into this position. We're starting to slowly get our toes into it. But the reality is, folks, if you're looking at that far right-hand side on the chart, and it's a dip, and you buy it, and maybe it goes down to $6 or $5.50. And let's say we've bought the bottom quartile of what it's going to do. And then from there, it takes a 3 to 5 year time period where it rises and it goes to $14 or it goes to $21. Okay. Just keeping the math simple, 2 or 3x. We bought it at the lowest point we thought we could. Maybe it goes a little lower, but all the risk was taken off from that $20 range all the way down to $7. And so from here, we think there's a good opportunity that they improve. Maybe we hold it for 18 months. Maybe we hold it for all 5 years, but we are going to look at trying to get that as close as we can to a home run as a double, but it's going to pay us in the meantime if we have to wait a little longer. It takes 5 years to do that. And if they grow the dividend, then your dividend is really producing 9% or 8% or 10%, because what you bought in at 7% is just going to grow in how rich it is, assuming you don't buy any more stocks. You buy that $100,000 purchase at $7.56, 53 cents, you've locked in a 7.61% dividend forever. And then if they keep growing the dividend, that percentage has just gone up because you purchased at $7, regardless of what the stock turns into. So there's a couple of ways that this fits into that model, and it's a catalyst for us to be entertained by the idea of it. And there's still some due diligence. We do want to see some turnaround effects, not just say they're going to do it with good leadership. We actually want to see it play out a little bit, and then we would be much more bullish on it than we already are.
I will say it's better than what you're going to get in a 10-year treasury or a bank account interest rate. Right. If you get a 7% dividend, you hold your money, even if it doesn't do anything, that's a better return than you're going to see on most places where you could park your cash.
That's the whole idea, right? Worst case scenario, it goes to $10 and it never does anything beyond that, but you got 7.5% return while you wait.
Well, great. There's one more we want to touch base on that might fit into that cohort of deep value. Copart. Now, before we started recording, Peyton, I had a question. I didn't even know what Copart was. So give the listeners the same rundown that you gave me about the company and what that story might look like.
Yeah, Copart they operate online. Well, you can do it online or in person, but it's mainly online salvage yard for vehicles in the marketplace. So you wreck your car, your insurance totals it, they send it to Copart to be sold for parts or to be auctioned off. And so the insurance company is going to give me $30,000 for my truck, they're going to auction it off for 20 grand. There's a $10,000 loss, but they got some money out of it. They're an insurance company, so they're supposed to, the whole point is to make you whole. And so we're buying on the other side of that, which is the Copart side, which is they take the vehicle, put it on their lot, and then they auction it off. So people do this from different reasons. I mean, it could be a rental company has a car and they sell it off. It could be insurance claims. Banks could take repos of cars and sell it off. Exporters of vehicles can export through this function as well. You as an individual can put a car there and sell it. Okay, that's the whole idea behind it. It's not a salvage yard. You can go pick apart. You buy the whole car and do what you want with it from there. But there's some rough ones and there's some diamonds. You just got to find them. But with that being said, it's a global company. It's got the largest market share. It's got great leadership. They've been doing this for a while. They're long-term thinkers and strategists. It takes a large piece of land to hold 1,000 cars. They're all parked together that don't run, that you got to pick up and move with a forklift, right? A giant forklift. So there's not a whole lot of people that would be able to buy them out. They're the largest player in their game. And they organically grow and expand, and they have been for many years. And so they have a great fortress of a balance sheet with virtually no debt. So there's a huge hurdle. Their revenues have been growing. Recently, they have had some revenues shrug off. So COVID put everybody online, everybody buying online, exporting online. At some point, a lot of things got picked up that way. Zoom was one of those. Home Depot and Lowe's were one of those. Everybody's buying online, picking up, fixing their house.
This Zoom evaluation was insane.
Yeah. So this was a story where they had a great run up into the 60s. And then, from there, people said, this has gotten a little overblown for the revenue, for some other factors. And so it has tapered off. Now, with that being said, there are just sometimes people do things, which we all know people who do this for no good reason. They just do something. You're like, why'd you do it? I don't know. It just seemed good. People would sell out of a company like Copart and go buy a company like Google on the hopes that they quadruple. Because they're the biggest tech firm, why not, right? So you have a little bit of that also playing into certain sectors. So when we look at a company like this, good operating margins, really good operating margins, right? Low expenses because they have virtually no debt, and then all margin as much as they can make it. And they own their properties because they're not leveraging for them, and they have consistent cash flow coming in, free cash flow coming in and growing. And so the revenues haven't been growing recently, but it's a turnaround story as we wait. We think that Copart, in our eyes, can definitely be worth a $50 stock. So again, it fits in the model. I think it could be higher than a $50 stock, to be honest with you. When you do the underwriting and you do the price to earnings, you look at a lot of opportunities in the future, what it's growing to. It's not going anywhere. And the challenge is to get overseas growing like they've had the U.S. grow. And if they can do that, that sector of their business is going to ramp up. And so then we're going to see an expansion. And then, global markets will get a little bit bigger for them. They've already been doing well, but they need to be a bigger player there than they are just in the U.S. And so we are dependent on total loss vehicles or wrecks. That's unfortunate, but that's how that game works. And, if it's a $50 or $60 stock in a 3 to 5 year period, investors aren't going to be upset, with that kind of return. So that's part why they fit into the model. They have a good, solid business model, and we know exactly what they're chasing.
Yeah. And one of the things that you highlighted a little bit earlier that I want to reinforce, because I think it's important on why this model works the way it works, is because we're the devaluation. Obviously, for when it was valued late 2020 or I guess mid 2025, you got a little bit over a $60 stock to where now it's about 55% from its all-time high. Wall Street is the only place that I can think of where you could have a clearance sale and people are running out of the store rather than in the store. My two sisters, they love I forget what it's called. It might be Lululemon, but I don't keep up with those kind of clothing brands. But if that was on a discount, they had a clearance, everything must go in that store. God help my dad's checkbook. So Wall Street's the only place where I can think of where you can get a discount. And if you do the correct research and if you know what you're buying, it's a great opportunity to look at things like this. And it gets me excited. Obviously, there's a bunch more questions that I have in my head, but I do not want to keep the listeners here for an hour on end. I would love to do more deep insights about some of these stocks and a lot of talking points about it, but limited amount of time we have. But at the end of the day, if you guys have questions yourself, you have a direct contact link to me, Peyton, Noel. We're always here to talk about what we're doing, why we're doing it. So please reach out to us. 864-582-7766 is our office number. We can more than happy to talk to you about what the reasoning behind some of this value or what the research that we're doing behind these companies. Or if you're interested just to learn a little bit more about the model, we did a very quick overview and there's a lot of nooks and crannies into it that we can talk about to make you feel a little comfortable about that kind of model. But tons of cool. That's just one of the aspects that we're improving on at ProVest, and there's tons of other things that we're doing. So I think the future of the firm looks, and I'm obviously biased, but I think the future of the firm looks fantastic. And Peyton, it's always good to have another like-minded person on the team. And now that you're here, I'm even more excited than beyond excited. So
there you go. Happy to be here. Glad we could chat some stocks. You guys stay tuned. We'll be talking about these each month and maybe some different varieties of them, not always deep value, but it'll be a little bit of what we're looking at. And we'll get into some ETFs and big picture stuff as we go.
Yeah. Well, thank you guys for tuning in to another episode of the ProVest Pulse. We'll be back in a couple of weeks for the next episode. And until then, we'll catch you guys on the other side.